Hello, everybody. Welcome to Chapter 1 of the Fundamentals of Financial Accounting course. Before I proceed with this chapter, a couple things you should be aware of. First, you should have already reviewed the course outline prior to uh, jumping into Chapter 1. So if you haven't done that yet, please go back and do so. Second, you should have printed off a copy of the Chapter 1 Word file. So as we proceed here with this video, you can fill in the blanks. So if you haven't done that, please go back and do that. What is accounting? Accounting is best defined as the language of business. It's an information system which performs three essential functions. One, it measures business financial activity. So accounting systems help us keep track of key information which can be used for reports and decision making. So a modern day example of this concept in action would be a small business owner named Rachel who keeps close track of her merchandise purchases and their eventual sales prices. This process of maintaining financial records of transactions is called bookkeeping. So basically everything that happens in your business, you keep good track of it. That's accounting function number one. The second essential function that the accounting serves is processing information into reports. By consolidating information into readable and understandable formats, accounting helps the business communication and decision-making processes. So imagine Rachel's computer software can automatically add up the merchandise orders for the month as well as sales. So this is how typically the accounting world works now. When you buy something, the system itself monitors what you bought, and at the end of the day, someone like Rachel can request a report. So the computer can print out a nice report which tells her what her sales are and some other important information. And third, accounting communicates the results to decision makers. So I kind of touched on that in the last step. With key information available from financial statements, accounting ratios, trend analysis, etc., managers are able to make better business decisions. Consider what Rachel can do with information about how her purchase costs are changing compared to sales volume. With detailed reports on hand, she can make better decisions about merchandise purchases, price levels, and marketing strategies. So it makes it really easy to access specific information now. So you can easily determine with a good accounting system if you're making a profit on a certain product or service. You can determine which customers are helping you make the most money. There might be customers who are resulting in a loss position for your business, right? You might want to just get rid of those customers, right? Marketing strategy, who should you be selling to? How much should your products be? So all these are important questions which can be answered more easily with the current accounting software and methodologies out there. Let's look at another important concept in the accounting world, which is financial statements. They can be viewed as the end result of what accounting does for us. Financial statements are key products of an accounting system which provide information to users to help them make better decisions. Some commonly used financial statements are the income statement, balance sheet, and the cash flow statement. These and other financial statements report on a business in monetary terms. Important questions like the following are answered with financial statements. 1. Am I earning a profit? 2. Am I in good shape to grow my business? 3. Is my business performing better or worse this year compared to last year? How does my performance compare to my peers and competitors? And am I at financial risk right now? So all of these are important questions which businesses and business managers ask themselves on a regular basis, and accounting helps us determine answers to these questions. So who exactly uses financial statements? This group can be small or large, depending on the nature and size of the business. Some common users are managers. So anybody in a decision-making position relies on accurate, timely, and relevant information in their decision-making process. We also have creditors and suppliers. Banks and other lenders analyze risk and business viability prior to extending credit. So just imagine if you were a lender, would you not want to see the numbers of a business before you make a loan or even an individual? We want to know, is this individual trustworthy? What's their history? Are they in a profitable business venture? Right? So all these are very important questions. You also have shareholders. So in other words, investors. They rely on assets, business performance, and other things as a predictor of future profitability. So if you're trying to make an investment in a company and they don't provide you any information, you're probably not going to go ahead and hand over a check. And finally, government and regulatory authorities. So one, financial information is very important for determining the amount of tax that a company should pay. And second, regulating companies often relies on financial results. So if a company is doing something wrong, a lot of information can be gained from their finances. Okay, so this is a good spot to stop this video, and we'll continue on in the next clip.